Mr. Will, we are live, sir.
Good morning, brother. How you doing, Rich?
As always, I'm doing better than I deserve.
Aren't we all? Aren't we all?
I certainly hope so. Did Santa bring you everything you wanted?
Absolutely. Healthy family, happy kids. And as usual, every year when the kids open the presents, I'm just as surprised as they are because I have no clue what the wife gets them.
You and me both. Sometimes I'm surprised.
It's like I get an extra Christmas. It's awesome.
Sometimes it's like I'm surprised when my wife opens her stuff. You know, my one of my daughters is pretty good about buying mom stuff or wrapping mom presents for me. So
I got the wife one this year. I'm kind of proud of. A little saying that we've come to try and embrace in our hectic lives with these things that we're talking about in business and family and life is I got her a big metal sign that hangs over our bed that says, "Give it to God and go to sleep."
I like that. That's what we all need to be doing. John Shriver says, Happy New Year's from Yukon, Oklahoma, AWS coin number 1919. Greg Gomez is on from Texas. He's coin number 2060. If you want to know what a coin number is, click that link at the top of today's show notes. We got 13 folks joining us already. Looks like some people want to find out more about the emerging financial threats we're facing, Will.
Yeah, that's an awesome thing. I think we're going to get up through a lot of material today, pretty much get to present day. Then we can move into what you and I were just talking about off air to get prepared for these things we see coming after that groundwork is laid out.
That's exactly right. So if you're just joining us, Emerging Threats Monday, Will and I have kind of taken you from the founding of our country. I took us through, Will, we covered up on the housing crisis, 2008, 2009.
Yep.
Will is going to take it from there up until today. And then for the rest of the year, we'll kind of be talking about things that you can do to prepare you and your family against these threats that we talked about.
Yep.
Let's talk about sponsors real quick. I'll make it really brief this morning. We're very, very blessed to have some amazing sponsors. You know who they are, folks. Century Martial Arts, makers of the Bob XL. We've talked about it. This is an amazing striking opponent. We also have Appalachian Standard, makers of the finest CBD products your money can buy. If you haven't looked into CBD, do the research on it. And if you feel it's the right thing for you, then I encourage you to check out Appalachian Standard. All of our amazing sponsors, you can be found in today's show notes. Go to AmericanWarriorShow.com. Right-hand side of the screen, you'll find links to all of their products with deep discounts for being a watcher of the American Warrior Show. We also have Mountain Man Medical. I'm telling you, folks, you're going to have to pick up one of those trauma kits. We've seen what the last couple of years have to offer. I don't see things getting much better in 2022. So please pick up a IFAC kit for you and your family from Mountain Man Medical. Cool Fire Trainer, Will, you want to tell us about the Cool Fire?
Yeah, man, it's a step up from dry fire. You replace the barrel recoil spring in your gun. It is gun specific, so be careful when you order that. The website's very good about that, but be cognizant of that. And you replace that, and then you charge it up with CO2. And when you pull the trigger, it's your trigger, your gun, your sights, your everything. And then you get some felt recoil. And it's an awesome way to train. I'm going to be using mine today. I know John Shriver, who wished us all Happy New Year. I know he has one. He was telling me about that. It's an awesome way to practice, awesome way to introduce new shooters to a little bit of recoil before you take them for their first live fire session too.
That's exactly right. Last but not least is Precision Holsters. Precision Holsters, makers of the Fast line of holsters. They got you covered whether you're looking for competition holsters or you're looking for a good appendix holster. The Ultra Appendix is the one that I use. Mike Seeklander has a signature line. Check them out. Looks like Dr. Fuller is on. Please like and hit that share button. That's enough about sponsors. I think we've paid the bills, Will.
All right. So I think we're going to move on into the show there, Rich. We're going to start off with something new. We're going to play a video here. So we're trying to up our game a little bit.
We are certainly going to at least give it a shot here. Let's see. Video file. There we go. This is the first time ever. Here we go.
Look, I was there when the Secretary and the Chairman of the Federal Reserve came those days and talked with members of Congress about what was going on. It was about September 15th. Here's the facts, and we don't even talk about these things. On Thursday, At about 11 o'clock in the morning, the Federal Reserve noticed a tremendous drawdown of money market accounts in the United States to the tune of $550 billion was being drawn out in a matter of an hour or two. The Treasury opened up its window to help. They pumped $105 billion in the system and quickly realized that they could not stem the tide. We were having an electronic run on the banks. They decided to close the operation, close down the money accounts, and announce a guarantee of $250,000 per account so there wouldn't be further panic out there. And that's what actually happened. If they had not done that, their estimation was that by 2 o'clock that afternoon, $5.5 trillion would have been drawn out of the money market system of the United States, would have collapsed the entire economy of the United States, and within 24 hours, the world economy would have collapsed. Now, we talked at that time about what would happen if that happened. It would have been the end of our economic system and our political system as we know it. And that's why, when they made the point, we've got to act and do things quickly, we did. Now, Secretary Paulson said, let's buy out the subprime mortgages. That's what he came to Congress. But he said, give us latitude and large authority to do many things as we decide necessary, and give us $700 billion to do that. Shortly after we enacted our bill with those very broad powers, the UK came out and said, no, we don't have enough money to buy toxic assets. Instead, we're going to put our money into banks so that their equity grows and they're not bankrupt. And so the UK started that process, and that's true. It was much cheaper to put more money in banks as equity investments than to start buying their bad assets, because it became early determined that we'd probably have to spend $3 or $4 trillion of taxpayers' money to buy these bad assets. And we only had $700 billion. So Paulson made a complete switch, went in and started putting money in buying securities and reinvesting in the banks in the United States. Why? Because if you don't have a banking system, you don't have an economy. And although we did that, it wasn't enough money, and as fast as we did that, the economy has been falling. And the reason last week, we're really no better off today than we were 3 months ago, because we've had a decrease in the equity positions of bank because other assets are going sour by the moment.
All right, Will.
Yeah, sobering stuff. That was
Very sobering. Wow.
the date he's talking about there, when that occurred, was September 18th of 2008. They were, it was an electronic run of the bank. So everybody, and we say everybody, we don't know who was pulling all the money out of the money markets. And that's the liquidity, that's the grease in the system, is that those money market accounts, because that money doesn't sit, just like money in your savings account doesn't sit. When the Treasury pumped $105 billion in there, they realized they couldn't stem the tide. So what the Treasury did after that was they cut off access to those accounts. So Grandma Smith, that needed to pull money out of her money market that day for daily living expenses, she couldn't do it. So the run on the banks isn't just going to be people lined up at the ATM like we saw in Greece after the crisis in 2008. It can be, you go to withdraw money or use your ATM card, nothing happens, your debit card. So there's something to be said for having some cash on hand.
I'm telling you, that's exactly right.
Yep.
If you don't have some cash on hand, you're living a risky life.
Yep. So that's one thing that doesn't get talked about much with that crisis, is they cut off access to those accounts. And that's, to me, that's a very sobering thing. You also notice they said they raised the limit from $100,000 to $250,000. Please, guys, be aware. Now, regular guys like us day to day, we don't keep that much money in a bank account, right? But maybe you sell a home and you haven't bought the other one yet. So something in those rare instances in life, something to keep in mind is that's $250,000 guarantee per depositor, not per account. So you have a checking account and a savings account. Even if you split it up, it's the total.
Yeah.
So when those things happen, it might be prudent to, put it in two different banks.
That's, as you're saying this, I think of my grandfather who amassed a small little tidy fortune here in East Tennessee, and he had money scattered all over banks, all over counties in East Tennessee for that very reason. He's like, I'm not putting it all in one place. I've seen what happens when there's a run on one bank or the FDIC. I'm not going to put all my trust in that. So,
well, it's diversification, right?
Yeah.
So, we don't just buy Apple stock. We don't just buy GE stock. We don't just buy Enron stock. We buy a little bit of everything, right? So diversify across those banks, because we don't really know how well managed any bank is. We go sign up for an account we just assume that they're well managed and guaranteed and so on and so forth. I can't remember if it was in that video or not, but they estimated that if they would have let that run by 2:00 that day, $5.5 trillion would have been withdrawn.
$5.5 trillion in one day. Is that what I'm understanding?
Yes, that's what you're understanding.
Yeah, and again, it's like most of this money is just bits of information. It's ones and zeros. It's not grandma standing in line at the bank or whatever. It's people pulling money out electronically, and I think that's what this is about, an electronic run on the banks. And it could be a prelude to something else we could see. I mean, this is what, 2008, Will?
2008, yes, sir. Yeah. And we talk about fourth generation warfare, cyber attacks, things like that. Imagine a cyber attack on the banking system. You want to bring everything to a screeching halt. I stopped by a fast food place yesterday, and they weren't taking credit cards, and it brought them to a screeching halt because I was one of the few guys with cash.
Yeah,
I mean, I went from fourth in line to first in line real fast.
I know that's a great lesson right there, man.
Yeah,
last in line to first in line. I have cash. Can I keep moving?
Just because I had a $20 bill in my pocket. The two first and second people in line didn't have any cash at all. Zero. The next one didn't have enough to pay for his order. So, yeah.
One of the sobering things I saw in your notes, and I don't want to steal this, but it's so impactful, and that is, if they had to let this run, you just said $5.5 trillion would have been withdrawn, and that would have collapsed the U.S. economy. And that right there, man, if that could happen then, what's to stop it from happening again? And as we talked about, the more we continue to print money to get ourselves out of problems, the more we got sloshing around the economy, and the more precarious the situation becomes.
Yep. And I'd say we're more vulnerable to it now, right? Because in 2008, we weren't, we used credit cards and debit cards, but not like today. I mean, people still carried cash back then. I mean, back in the olden days of 2008, right?
Yeah.
Now, you tap your phone. That wasn't available then. It's so as we become more dependent on those systems, that's great when those systems work, kind of like the supply chain. So, yeah.
And Alan Kelly just says, to most people, 5.5 trillion is unimaginable. That's true. But I think that doesn't stop a layperson from thinking, oh yeah, million, billion, trillion. What's the problem? As we've said before on the show, you can count to 1 million. You go through 1 million seconds in 11 days. You go through 1 billion seconds in 32 years. You go through 1 trillion seconds in 32,000 years. 1 trillion seconds ago, man, woolly mammoths were running across Europe, and Neanderthals were fighting it out with Homo sapiens across the plains of Europe. That's 1 trillion seconds ago. So imagine 5.5 trillion. Like you said, Alan, it is unimaginable.
If you listen to my kids, that's about when I was born.
I've heard that.
They like to remind me I'm getting old. So and this one's been fairly widely published. Hank Paulson, who was Secretary of the Treasury at the time, went to Congress looking for the $700 billion TARP funding for the TARP program, and he told Congress he scared them pretty good. He said, if you don't approve this within a day or two, we will have to institute martial law in the United States.
And as we talked about before, what's a guy from Goldman Sachs know about martial law? However, some of these things, though, are just a mathematical problem. It reminds me of the Titanic as an excellent metaphor for this. But this ship can't sink.
Yeah.
He's like, it's made of iron, sir. I can assure you it can sink.
Yeah. Yep. And, we've talked about before, and we're going to get into it over the next few shows as we talk about other preparations. But there's the old saying, we're 9 meals away from anarchy.
Mhm.
So yeah, what does a guy from JP Morgan know about martial law? Well, nothing, but he probably knows enough to know that if you don't keep the masses fed, you're going to need martial law.
Yeah, you're going to need something, that's for sure.
Yep.
To your point about this being such a freaking threat, everybody thinks of the threat is going to be, you know, I don't know what they think the threat is, an invasion. I don't know, but I think someone hacking into our banking system and shutting our economy down is probably a much more likely threat. And you can
Mhm.
do that with a few keystrokes and access to the technology.
Yep. Few keystrokes, and whoever does it has plausible deniability, because once you bring that, if they can bring that system down, they can bring down the system it takes to trace that back to a given country or source. So then everybody has plausible deniability. I don't know how. Well,
I thought
it
you did
wasn't
it.
me.
Don says within the last 20 years, Iceland and Cyprus have both had banking system shutdowns that disrupted, closed all banking operations. ATMs shut off and credit cards wouldn't process. If you don't have cash, you couldn't buy anything. And Greg tells us the height of a stack of $1 trillion $1 bills is 67,866 miles.
That's a bit of distance.
That's a bit of distance. Yeah.
Yeah. So, all right. So after all this happened, we got the housing crisis you talked about. The economy fell apart. Then they got to do something, right?
Yep.
So they moved in to stabilize the banking system, and as much as I didn't like it at the time, something had to be done to some extent. Now, of course, like everything, they overcooked it and realized, hey, this power stuff's kind of cool. And so then they started using more of it. So let's kind of step through the different QE programs we've had, Rich.
If we
So
explain QE, you're going to explain
Sure.
QE?
Yep.
Okay.
So QE is really, it's just a fancy way of saying we're going to print a bunch of money. So let's break down those words, because words mean things, right?
Yep.
Quantitative. Root word, of course, is quantity. So So we're talking about the quantity of money. And easing means we're going to make more of it, so it's an easier environment. So quantitative easing. So basically, this is a funny way of saying money printing.
Yes.
Okay. So, and of course, because we couldn't just do it once, we're going to have a bunch of these here. So we've got QE1, which at first was just called QE. And the Fed purchased $600 billion worth of toxic mortgage-backed securities, like you talked about last time, and bought these from commercial banks. So let's set the groundwork for this. So these banks made a bunch of bad loans based on the bad lending standards, bad appraisals, like you talked about last time, and now all these properties, all these loans are underwater. They're toxic. Okay, so if they can't raise property values, if they get them off the books, now the bank is financially healthier, right? So the Fed went in and bought $600 billion worth of these. Now, it's important to know it's a gross dollar amount. There's a dollar amount there. We're going to buy this much, and then we're going to stop. Okay, because that's going to change later on. So they did that, and that was November of 2008, and that worked to an extent. So these banks are healthier now. They gotten rid of their bad assets. So that worked pretty good. So a couple years later, November 2010, 2 years later, they did QE2, cleverly named. I know. Try to keep up there, Rich. All right. The Fed purchased another $600 billion, but this time they bought treasury bills. Now, the difference there is, as we talked about, the government can't just send money out. They have to sell a bond to someone who pays money for it, and then the government can do things with that money. So this is how the Federal Reserve gets money into the system. Does that make sense?
Yes. Yes.
Okay. So the second one was about pumping money out into the system. Now, where the government sent that money, we can go back and research it. Was it infrastructure? Was it handouts to corporations? Was it to banks? It was a little bit of everything. Okay. So came time to do something else, September of 2011. So you notice it went 2 years between the first two programs, and now we're down to a year to the next program.
Yep.
So it's like the credit card debt. It just keeps getting worse and worse. This time, though, they didn't print money. They were starting to lose control of interest rates. And interest rates, as we know, will greatly influence people's behavior, business behavior, banks' behavior. So they wanted to exert influence on people through that. So they did a program called Operation Twist. And what they were doing, there's short-term bonds and long-term bonds. And short-term bonds typically pay less interest than a long-term bond because you're in a short-term bond, you're not locking your money up for as long, so you don't get as much return on your money. Okay.
Mhm.
So what they wanted to do though was manipulate those interest rates, short versus long-term interest rates. So the Federal Reserve would go in and buy either short or long-term bonds and then sell the other end of the curve. So they could go in and buy short-term bonds and sell long-term bonds, or buy long-term to drive those rates down, and then buy short-term bonds. So they did that to manipulate the interest rates. You tracking on that, brother?
Yep.
Okay. All right. So they did that. Then we got QE3. That was September 2012, a year later. So it went from 2 years to 1 year to 1 year. Okay. Now this one's different. This one, the official name is QE3. It was commonly called in the financial industry QE Infinity. Because each of these other ones, remember, had a gross dollar amount.
They did.
This is
600 billion, 600 billion, whatever.
Yep. We're not talking real money yet.
No,
We're not talking real money yet. Now QE3 is called QE Infinity because now it's a monthly dollar amount. And it started
What's the
off
monthly
with-
dollar amount?
Oh, it's only 40 billion.
Only 40 billion. Okay. Well,
Only 40 billion. I mean, you got that in the shoebox, right?
no, I wish I wouldn't be on here, buddy. I tell you that.
We'd all be living on your island and going shooting every day. Even
That's
we
exactly
wouldn't
right.
care what ammo prices were.
No.
So the Fed purchased $40 billion a month of
Gosh.
mortgage-backed securities because the banks still weren't getting turned around, right? By definition, we can look back in history and know that. Otherwise, they wouldn't have had to go buy them, right?
And again, it's like all these bad deals that they made,
Mm-hmm.
as we talked about last time, those idea of, oh, yeah, but the banks are too big to fail. It's not really that as much from my research. It was, we can't put everybody in prison.
Mhm.
Ultimately, only one guy went to jail. One man. After
And they all know each
that.
other.
Yeah,
Say
of
when
course
Hank
they do.
Paulson went from J.P. Morgan to Treasury. They all know each other.
It's an incredibly incestuous relationship in that.
Yep. I think you've given incest a bad name. And I take that in perspective, of course.
That's right.
All right. So that was September of 2012. Remember, 2 year, 1 year. Remember that?
Mhm.
So 40 billion a month in September 2012. That went pretty good for a little bit, but by December of 2012, a whole 3 months later, they upped it to $85 billion a month.
Jesus.
What's that tell you about how bad things really were? But if you turn on any of the news channels, oh, everything's great. They're getting it under control. Blah, 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 blah.
Well, and the bad things were sounds as if it was past tense.
Yeah, that's true. That's true.
The chickens may be coming home to roost.
Yeah, they sure are. So now we're up to 85 billion a month. That's 45 billion a month in treasuries. So that's just straight up pumping money into the overall system through the federal government. And $40 billion a month in mortgage-backed securities. So we're just continuing to feed the lion, so to speak, hoping we get 8 last, right?
That's exactly right.
I think the saying's an alligator, but you get the idea. So they did end QE3, QE Infinity. Actually wasn't until Infinity. That ended in October of 2014. So that went on for basically 2 years.
Mm-hmm.
So what did these programs do? I mean, there's the obvious. It printed money. It bailed out banks who were irresponsible. Like everything else, it's a double-edged sword. It's like when you go shooting, you don't get to be as fast as you want to be for a level of accuracy, and you don't get to be as accurate as you want to be for a level of speed, right?
That's exactly right.
So what these programs did do short term, though, is they did stabilize the financial system. We can't take that away from it. It did do that. Okay, right, wrong, or indifferent. Those people should have failed. People should have gone to jail. I'm not saying the opposite of it, but it did stabilize the banking system. So frankly, I'm thankful for that because I wasn't as tuned into this stuff as I am now, not as ready as I am now. So I am thankful for it from that perspective. The problem was it reinforced irresponsible behavior for the banks, which obviously has not ended.
Oh no.
So in a perfect world, the good banks or the bad banks would have failed back then, and the good banks would have been okay, right?
Yes.
Well, what happened was because property values kept dropping during that period of time, they just stabilized, but they were still on a slow downwards slope. Good banks got caught up in that, and they wound up upside down on stuff as well. Um, Rather than letting the pain ripple through the system and then a recovery happening. Um, just like,
I was thinking of this housing thing. You were saying you weren't watching as close. So maybe I was in a slightly different position because in the Marine Corps, you have to move every 3 years. So my community of Marines were constantly buying and selling houses because at the most you're going to be somewhere as 3 years. So
okay.
I knew my friends were like getting rich, and some guys were gunnery sergeants making $300,000 in profit selling a house in California to move East Coast. And so it was just insane during this time period before the crash. People were just making money like it was cool. And I remember a friend of mine had gotten out of the Marine Corps and started a contracting business. His wife was a real estate agent. They were living in this giant house, had us over for a barbecue, and they've got this Italian style villa, a kitchen outside. And it was just like, holy crap, how do you afford this? You're a retired enlisted Marine and your wife's a real estate agent. And he's like, and I remember him, he had a dip in. He's like, Brown, things are just good, man. And it ain't never going to stop, buddy. It's just going like this. And I'm like, oh my God, you don't understand.
It's different this time.
I know.
Different this time.
When he was looking at me with his eyes glazed over with the amount of money he was making and just, you don't understand, Brown. It's just never going to keep going up. And I'm like, wow.
Yeah. And, it's that irrational exuberance Alan Greenspan talked about back in the day, right?
That's exactly right.
And there's the old saying, be when others are greedy, be cautious, and when others are cautious, be greedy.
Yes.
So, so let's talk a little bit about what the home prices did back then. Just kind of touch back on what you talked about. Average for the nation was down 40% in home value. Some areas, obviously, a lot more. I know I was down in Phoenix around about that time. There were some places where it was down 80%, 90%.
Whoa.
I should have pulled the trigger on that one. I still kicked myself for that one.
Yeah.
And commercial property is a different animal because it has to be refinanced so often. And as I alluded to on another show, talked about on another show, a lot of commercial owners found themselves in a corner where they could make their mortgage payment, but they couldn't get a mortgage because the property value had gone down so much.
Yeah.
So a little quick refresher on the stock market during that time. The S&P was down 38%. And your 401k on average was down 27% across the system. And that kind of leads us into the next thing. So the Feds, the Federal Reserve started backstopping the stock market. And that was, just like back in the housing market, short-term need, if you will, because people were, as they watched their 401ks go down, they got scared. They started pulling their money out, and it becomes that self-licking ice cream cone where it just spirals downhill. It's like the whole psychology of the market thing. So they started banks, large institutional banks, your JP Morgans, your Bank of America. They started borrowing money and buying straight into the stock market. And even back then, a close stock market watcher, you could, if there was a big red day, a big down day, about 30 minutes before market close, all of a sudden it would stabilize and come back up. And nobody knew who was buying the stuff. And the theory was always that it was the large banks through the Fed borrowing money for basically free and going in and buying the market. This became known as the Fed put. I won't get into the whole what a put is. Basically, it puts a floor on something. It's an option strategy. If you guys want to look it up, just go search option strategy put, PUT. That would be a whole video in and of itself. Basically, it sets a floor on something. It would be like, Rich, you're going to buy your farm for X dollar amount. And I guarantee anytime in the future, I will buy it for that X minus 10%.
Okay.
And good, bad, or indifferent from an investment standpoint, for me, it puts a floor on the price for you.
And hedges my risk. Right.
Exactly right. Exactly right. So basically what the stock market, so when I say the market from here on out, it's going to be talking about the stock market. The market got used to the Fed always coming in and rescuing the day. Buy the dip because the Fed's always going to come in. And there's an old saying in the markets, don't fight the Fed. And typically what that refers to is interest rates in the past. If the Fed's lowering interest rates, the stock market's going to go up. Don't fight the Fed. So
yeah, and Robert is on this morning. Robert was a guest on the show, and Robert, I believe, is a day trader. And he says, "Good morning. The plunge protection team kept busy." Yeah.
Yep. Absolutely. So let me see here, find my spot. And personal note, I've called 9 of the last 2 recessions. Okay. Because there should have been about 9 in that period of time. Okay.
Yeah.
But the people who kept buying the dip, I'm gonna tell you, they beat me. They were right. And I hate to say it because I hate losing.
Yeah.
But they were right because they paid attention to what the Fed was doing better than I did. Unfortunately, one of these times I'm going to be right, and it's going to be really ugly.
Yeah, when you're right, it's going to be bad.
It's because this rubber band's getting stretched, man. It's just bear in mind, we're still talking like 2011, 12. And
Yeah.
we got another decade after that now doing the same sort of stuff. So it's not pretty out there.
Yeah.
So this is also, we keep talking. You talked about it last time. Remember talking about moral hazard, Rich?
Oh, yeah.
Yep. Well, it just gets more and more moral hazardy here as we go along because the Fed keeps backstopping bad behavior because we can't let people experience any pain, right? And we're seeing more and more of that as time goes on here. So what these banks learned was if you got big enough or influential enough, you can do whatever you wanted. Take bigger risks because you're too big to fail now.
Yeah.
Too connected. You know where the bodies are buried. You know where the skeletons are in the closet. So basically take riskier and riskier bets, gambles, investments. And if things go sideways, somebody's going to step in and write you a check.
That's exactly right.
So this coined a phrase which is privatize the profits and socialize the losses. So when those gambles paid off, all those profits stayed inside those banks, as they should at that point, because they took that gamble. Now, here's the problem. When they took their big losses, which of course they did, when they took those losses, well, now we need a bailout.
Exactly.
So now the losses become the country's losses, socialized the taxpayers' losses.
The problem is when you and I take a bad gamble and lose, nobody's bailing me and you out.
Nope. Just the opposite. You were irresponsible.
Yeah.
But if you get to be big enough now, well, there's risk here. There's systemic risk. We have to do something. So, so I see you brought Michael's comment up there. How is the government keeps covering for big banking is the 2010 Supreme Court decision, Citizens United. I don't know how Citizens United plays into that directly. I'm familiar with it at about that level of the name and what the outcome of that decision was. And I'm torn on that decision, to be honest with you. But I think the reason the government keeps covering for big banking is what they can't have is societal breakdown on a bigger picture. That's really, I think that's the root cause of it.
Yeah, but this whole, this idea, and it's worthy of hearing one more time, privatize the profits and socialize the losses, because the socialized loss is shouldered by me and you, which is not good.
No, and it creates that yet another division in our country, right? Because those people, they get bailed out. While those of us who work jobs and are trying to build something for our families, we have to eat it. Higher taxes, inflation, because when they print this money to do this stuff, the rich of the world don't care about inflation. They have so much discretionary income, they couldn't care less about 6% inflation. Who cares? You don't eat so much food, right?
Yeah.
So, you get a 6% rise on caviar. Oh, well, on my $200 million yacht, who cares, right?
But a moment ago, the phrase "buy the dip," and I want to make
Mhm.
sure people understand that and how the mentality has really kind of taken hold. Can you explain that a little bit more?
Sure. So when the stock market dips, goes down, there's always corrections, within any movement. If the stock market is going up, there's going to be days where people take profits, and that will cause the prices to go down and hence dip. Okay. Now, this can be on a day, this can be on a week, this can be over even a series of months. It's also called a correction. A correction in a stock market is a healthy thing because it gets out people who are too euphoric. It's a balancing system. Okay. So when the stock market goes down, if the stock market or anything, housing, anything is generally on an uptrend, during those times when there's short-term fear and selling, the price will go down. And those are buying opportunities inside that larger pattern of the market going up. Does that make more sense?
Yes.
Okay. Now, the flip side of that is if a market is generally going down, there'll be days when it's up.
Mhm.
And is that really the turn in the market, or is that a head fake? And the answer is you never know until later on when you can look back at the chart and see what it did afterwards.
Yeah.
Which is what
Like
makes
it-
it fun and challenging, right?
I'm reading your notes here, Will, and it says, during a bad period, just don't open the statement. Everything will be okay.
Yep, that was exactly what an ex-financial advisor told me. I called him up, said, "Hey, what's going on? What's our best strategy here?" And he said, "Just don't open your statements. Just stay in the market."
Well,
And I was
you don't realize the loss unless you sell.
exactly. And
But
you know what? And you know what? Here's what I really hate. He was right.
Yeah.
Because the Fed kept pumping money in. Now, did he know he was going to be right for that, or was that just a talking point from corporate? I'm sure it was a talking point from corporate.
Well, again, if you're diversified, that's okay. If you're all in on Frontier Communications and you think you're buying the dip, and Frontier has invested billions of dollars in dead technology, and it's going to zero,
Yep.
That's something.
Yep.
But if you buy the dip when Reed Hastings makes his boneheaded play with Netflix, you're pretty well set right now.
Exactly right. Yep. So do you know whether you're buying the dip or another financial term? Maybe you've heard of it, Rich, is a dead cat bounce.
No, I haven't heard that.
Well, apparently I've never done this, but apparently if you throw a dead cat out of a window from high enough up, it'll still bounce.
I did not know that.
I've been told that. Now, in stock market terms, that means if the market goes down fast enough, far enough, there's going to be some people who see opportunity there and buy back in. And that's going to cause the market to bounce, just like a dead cat hid in the ground.
Okay.
So the question is, when you go through a series, a time of pain like that, okay, is this really the market turning around, or is it a dead cat bounce? In other words, it's just going to keep going back down again.
Is that like, would that be like GameStop?
Yeah.
Okay. I mean, it's people are holding on to this thing, but it's dead. I mean, that's that kind of storefront.
Yeah,
business
that part of their business. Now GameStop is diversifying into a lot of other stuff. I'm not really up on GameStop. I've dabbled in and out of it, but I'm not that familiar with their business model. But obviously, yeah, the brick and mortar side is dead. But I know they are working hard on getting into some other stuff. I don't know how successful they'll be, of course.
I hope they make it.
Yeah. All right. So let's talk about inflation, which is really our core thing here we've been building up to. So with all this money printing, all this monetary expansion, quantitative easing, right? We've seen very little inflation until the last year, since the pandemic started, really. So you take that time period in between 08, 09 and up until post-pandemic-ish time here, we really didn't see a lot of inflation. So were we all wrong about you print money and there's inflation? Well, it depends on where you look at. If you look here in the United States, that's true. But the money didn't just stay here. If the money had stayed here, I think we would have seen huge inflation, but the money didn't stay here. We've been exporting the inflation. And way back when, Rich, you talked about trade deficit. Remember that?
Mm-hmm.
Okay. And there's two ways to look at trade deficit. One is it's a bad thing. We should be making things here in the United States, employing Americans, good paying manufacturing jobs, good salt of the earth people making a good living, right?
Right.
Well, but if that money had stayed here in the United States, we'd also be looking at big inflation.
Mhm. Yeah, I've heard that we export our inflation.
Yep. And that's exactly what occurred.
Yeah.
Look at China's become a wealthy nation since they joined the WTO, and I think it was 1990.
Mhm.
And the reason is we've sent them a whole bunch of money, and so is the rest of the world, but mainly us. So that's where our monetary expansion is, where a lot of it went, was to China and other emerging markets. So the trade deficit is like everything else; it's a double-edged sword. So if we wouldn't have had that trade deficit, we would have had a lot more inflation already. I believe we would have.
No, I
Because
think you're
where
right.
else would it go?
Right.
Okay. So the other thing that's happened is all that printed money has driven one asset bubble after another. Drove housing, drove the stock market, just goes from one bubble, it pops, moves into another asset that at that time is undervalued, and then drives it up into an overvalued bubble.
Well, I think that's what a lot of people say about crypto at the moment, right?
Sure. Yep.
Everybody's looking for an asset to put it in.
Yep.
Crypto is just going through the moon, right?
Yep. And just like every other bubble, you don't know if it's really a bubble until later. We can all theorize and so on and so forth, but until it pops, you really don't know for sure.
Money chases a return.
Absolutely, brother. So now here's where we get into our vicious cycle. So we'll just use China as an example. So we send a bunch of money to China, right? Mm-hmm. They make a profit on this stuff. And now what are they going to do with all this money? I think you just said that seeks a yield, seeks a return.
Always.
So where are they going to put it? Well, they've already built a whole bunch of factories. So yeah, they'll build some more, but they still have money left over. They need someplace stable to put this money. Most stable thing in the world is the U.S. Treasury bill. Because it's reserve currency. You can always cash it in. You can always trade it. All international currency or trade has to be settled in U.S. dollars. So now you just hand them a Treasury bill instead of a check, so to speak.
Mm-hmm.
So now let's think about this for a minute. So we print a bunch of money, Americans. We have a trade deficit. We send that money to somebody else. That hollows out our employed class of people, right?
Mm-hmm.
They send products back over to us. We buy them. That money goes over there. They need someplace to park it. So they put in U.S. Treasury bills, and then we pay interest on it.
Mm.
It's like the credit card cycle with an extra cycle where you're not doing well.
Yeah. Yeah.
So now, obviously, that's
or a Ponzi scheme. I don't know.
Yeah, or a Ponzi scheme. At least a Ponzi scheme. Somebody's got to stand in front of you and lie to you. You can try and pick up on it, right? So now that's obviously not where all the money went, but that's part of the cycle. So it's a vicious circle. So now you add to that. Now we're also hollowing out the middle class, right?
Yes.
So
right.
some moved up and a lot moved down.
Yeah.
So now they need more government services. They end up on government programs, right?
Yep.
So now we got to print some more money for that, huh?
That's right. And the cycle continues.
Mm-hmm. Yeah. For how long, Rich?
Till the chickens come home to roost, pal.
Yeah. And that's the problem, is we don't know, right?
Yeah.
We don't know. And what's the right move between now and then? We don't know. So we try to prepare for a little bit of everything, which is what we're going to get into after we finish this series up here. Okay.
Mm-hmm. Yeah.
So,
but like you said, if we off-sourced our inflation, is it coming back at some point? I mean, can we do, like you said, can we do this forever? Just push it off from the developing countries?
In thinking about this, here's how I've envisioned it. Okay. And I'm not saying this is necessarily the right way to envision it, but it's what makes sense in my small little brain here. Okay.
Mm-hmm.
We had filled America up with dollars, and then we started printing more dollars. And because we didn't want to have price inflation, we started sending those dollars over there, wherever over there is.
Mm-hmm.
Well, eventually we're going to fill up over there with dollars too. And once the whole world is filled up with dollars, then we see inflation. I don't know if that's how it mechanically works. Okay. So that's the way I'm envisioning. Does that make sense to you, Rich? I mean,
no, it does. I mean, we talked about, right after the Revolutionary War, the money was sloshing back and forth across the Atlantic,
Mhm.
but today it's sloshing around the world. And the
Yeah.
more you print, I mean, right now there are several world economies that only run on the dollar. They don't print their
Mhm.
own currency; they just use our currency.
Right.
Tony says, "What does our $28 trillion worth of debt really mean in hard terms to the average American?"
It means Tony owes us some money.
Mm.
That's what that means. It's to answer Tony's question the best I can. And if somebody else has a better answer, I'm totally open to it. What it really means in the way I look at it, there's I think it's usdebtclock.org is a running national debt clock. It's really a cool site. And it'll say how much is owed per household or per adult. It's broken down across a bunch of things. Now, obviously, we're not going to all write checks or take out a second mortgage to cover our end of that, so to speak. But the way I take it is, back to Tony's point, is it's that debt is working us into a corner, because now they can't raise interest rates realistically. I know the Fed came out and said they're going to raise interest rates a quarter point at a time, 3 times this year. I don't think they will, because every time, what was it? Oh gosh, I just read it. I think every 1 point increase in the interest rate adds $300 billion to the debt cost of the debt service.
Whew, wow.
Yeah, I mean, we're into that credit card thing I got into in my 20s, and every other irresponsible 20-year-old did. At some point you got to eat some pain, stop going out on Friday nights and pay it down. And the problem is we have more debt than there are dollars in circulation.
Yeah, and the idea of this giant, but debt, this idea that deficits don't matter. Well, they don't matter in the sense that sovereign nations can print their way out of problems, but you can only do it so long.
Yep.
There is a limit. Where is that limit? I don't know, but you can only stretch a rubber band so many times, and it's going to break.
And as you allude to, we don't know what the limit is until it's over. Oh, that was the limit. Huh. Shit, now what?
Yeah.
Okay. So I think we'll know what the limit is when they can't control inflation. Because the way you control inflation is raise interest rates. When you can't raise interest rates, inflation is going to take off because people are going to lose faith in that money.
We talked about this before, and I want to say it again because Tony's question is so succinct, man. It's like, okay, well, I hear you, but what does it really mean to me? Well, if you look at the Roman Empire, I think some excellent parallels can be made, obviously, to where we're in. And I think Gibbon said there's a 70-something year cycle to the death of Rome. And it really started with under the reign of several different emperors. They debased their currency. At the beginning, the Roman silver coin was 90-something% silver. By the time Rome imploded, it was less than 10% silver, which is just a way of money printing. Yep. Think of it in terms of money printing. You're devaluing your currency so you can print more of it and print more of it and print more of it, because you're spreading it around throughout the empire to pay off the Visigoths and the Vandals and everybody, so they don't come in and sack your city.
Mm-hmm.
And they're using it to run their own economies. I mean, they're exporting their inflation just like we did. Mm-hmm. And you see where it heads. But again, to your point, several emperors got away with it.
Yep. I
debased it to 80% silver. Nothing happened. I debased it to 50% silver. Look, they're still using it. They think it's good. And eventually it's worthless. Yep. So this is a cautionary tale, man. We really need to pay attention to.
Yep. And, you're back to your comment about deficits don't matter. I think that was Cheney that said that.
Yeah, I think he was quoting. But he was alluding to, like, Reagan proved that deficits don't matter.
Yep. And to an extent, he's right. Deficits don't matter as long as you can service the debt. Well,
they don't matter till they do.
Exactly. Yeah. But as long as the interest rate is this low and stays this low and everything else works in the system, then he's right. Deficits don't matter.
Yeah.
The problem is just like, credit card doesn't matter until I have to take a 20% pay cut because there's a pandemic and now I can't service that debt. It's the same idea.
That's a great point.
So, my brother-in-law, Jeff Brown, asks, would it be better for the U.S. Exporting more commodities or using it to build our own infrastructure? I think build our own infrastructure, but that's my opinion.
Yeah.
It seemed like gas was a whole lot cheaper when we were a net exporter of oil, but that's just me who has to fill up a diesel truck, you know?
Yeah.
What do I know? Boy, Nick, you could send me down a rabbit hole with this one. The limit is when they succeed at creating a one world currency, slow boiling the frog.
Mm-hmm.
Yeah, boy, there's a rabbit hole there we could go down.
Yeah.
So, all right. So we're ready to move on here, brother.
Please.
All right. So there was no inflation, Rich, right?
That's what they said.
Well, depends how you measure it. So can you bring up chart 1 there as we move on into our technological advancement?
Oh dear. Let's see here.
Oh boy.
How do I get charts?
Chart number 1, sir.
Chart number 1. Give me 1 second.
Sure. Alan Kelly, as you're doing that, Alan Kelly says the average citizen needs to realize reducing their personal debt will be advantageous when these bubbles burst, and that goes along with the points we're making here today. And man, he's right. You know, it's the way I look at it, because I'm also a business guy, is cash flow. The lower I make my debt, the more excess cash flow I have, and therefore more options I have. It gives me time not to panic because I'm not worrying about how I'm going to feed my family or do whatever else I need to do that month. That goes right along with, you know, a savings account, as old fashioned as it is, and having some cash on hand as well.
That's correct. Give me 1 second. Well, almost ready
no
here.
problem.
Chart 1. And we're getting fancy today.
Yeah.
I don't know about let's see. Here we go.
Here we go. All right. So M2. Okay. So just in the interest of time, I'll kind of gloss over the definitions. If you guys want to go look up the definitions of M1, M2, M3, all that sort of stuff, it's out there and easily accessible. So M2. The first thing I want to point out is up here in the upper left, it says discontinued. We'll talk about that in just a moment. I want you guys to point that out. I also want to point out, I feel like a Brady Bunch episode right now. It's like, hi, Rich. So, all right. Sorry. That mental picture popped into my head. You'll see this M2 chart. This is from the Fed. So this isn't some right-wing conspiracy theory. You look back to 1980-ish when this chart started, you can see that money supply growing, and the gray vertical bars there are where recessions occurred.
And did you explain that what M2 is?
Sure. M2, sorry, is the money supply is cash, checking accounts, and easily convertible instruments. This would be your money markets. For the most part. There's others as well, but the big one is the money markets, kind of where we started at. Okay. So this is monetary inflation. Remember, guys, there's 2 types of inflation. There's monetary inflation and price inflation. What we're hearing about a lot right now out there in the world is price inflation. Okay. Monetary inflation or deflation always leads price changes, price inflation or deflation, outside of the supply and demand curve, which is temporary. All right, so we're increasing our money supply over time. Take a look at that, guys. Look what happens at the end of that chart when the pandemic hits. It goes
hockey stick.
It goes as close to vertical as possible.
Yeah.
I did not grab it in the interest of time, but if anybody wants to go to Trading Economics, I believe it's .com. You look at the Zimbabwe chart; it's scarily similar.
Well, that only happens over there. I mean, that can't happen in America.
Oh, that's over. Yeah, over there. Yeah. Sorry, my bad. Never mind.
Yeah, can't happen here.
Okay, can't happen here. So let's go back to that big multi-syllabic word up there at the top again, Rich. Discontinued.
Yeah. Why did they discontinue that?
They discontinued that. I'm glad you asked that question, Rich. The Fed discontinued that because they said it was no longer a good indicator of inflation. Seemed to work for an awful long time, but then when they went all hockey stick on the money supply, that's not good anymore.
Yeah, don't look at the guy behind the curtain. Stop that.
Exactly.
He's not important.
Exactly. So we start here with the M2, the money supply, so to speak.
Mm-hmm.
Okay, so let's go back just a little bit, Rich, and let's talk about the 2 types of inflation. There's the PPI, Producer Price Index. Okay. And this is basically inflation for companies who produce things in the simplest of terms. Okay.
Okay.
That's in economic terms, that's a leading indicator, because that's going to turn into price inflation on the retail end when you and I go buy stuff.
Yes, because the raw materials for what they're building this product cost more, so they have to pass that price along. Is that correct?
Exactly. So you may remember in November, CPI came in at 6.8% year over year. So 6.8% inflation year over year. If memory serves, and somebody can fact check me on this, I believe PPI was 8.7, 8.4, somewhere in there. So that tells you about 6 months from now, that's where inflation is going to be.
Okay.
So, and it all comes back to this chart we're looking at again right here, that with that money supply going up, it's going to end up there because it's devaluing the currency. Okay.
True.
So now let's take a look at this, because historical perspective is good. Can you bring chart 2 up there, Rich?
Absolutely. 1 second. Look at us getting fancy this morning.
Yeah.
It's uploading. John Melly has a question, but we'll get to that in just a moment, John. It's an excellent question and one that we'll dig into more.
Yeah, that is an outstanding question. We're going to dig into that. I'll give you the short version of it here in a moment, what I think, and you can throw yours in there, Rich, and then we can dig into that more down the road. All right. So this chart got me because we all know it, but we don't have the perspective of it because we see it month to month, year to year, versus a longer period of time. This is from 1998 through 2018. Lower left, please notice, guys, that the source is the BLS. That's the Bureau of Labor Statistics. So it's not rightwing.com, leftwing.com, any of that sort of stuff. This is government numbers. Okay. So if we go back to 1998, use that as a 0 point, we can see how prices have changed since then. Top hospital services have gone up, 220%?
Yep.
Something like that. That would play back into your insurance premiums, your co-pays, your deductibles, all that stuff, right? College textbooks, college tuition have gone way up. There's a lot of cheap money out there for that, right? Low interest college loans. Next down is childcare, medical care services. Average hourly wages are up by that much over that period of time. That's a good thing, but you notice it's not keeping up with those things above it by any stretch of the imagination.
No.
As we move down, food and beverage, housing, just above that. And then we can go down cars, household furnishing, clothing, cell phone services down, computer software, toys, and TVs, all way, way down in price, relative, real dollars, inflation adjusted, it's down. Now, what I'd like to point out here, Rich, and what struck me about this is if you look at the top of the chart where prices have gone up more, that's where there's cheap money available or government influence.
Okay.
So government's heavily involved in hospital services, healthcare, right? Medicare, Medicaid, right? There's a lot of free money, low interest money, I really should say, for college. Look how expensive cheap money has made college, because they can raise the prices because, the payments are only this because it's 2% interest or 3% interest, right? But as you work your way down, okay, and I'm going to come out as a blatant capitalist here, but as you move from socialism-ish up at the top to capitalism at the bottom, stuff gets cheaper.
It does. I'm looking at that. Cars, clothing, TVs, toys.
There's no government programs for those things.
Cell phone services, computer software.
Yeah. So, and this is also something we're going to run up against as time goes by. If you look at, TVs, computer software, cell phone services, technology by nature is deflationary because it makes people more productive, makes things happen easier, right? That is at odds with a monetary system that must have inflation.
Okay.
So that's, to me, when I first heard about that, to me, it was a profound thing when I learned that, because when we talk about, all this great new technology, well, that's great, but that's making things cheaper. And that deflation does not work in a debt-based fiat currency system. It's got to have inflation to pay off that future debt.
Mm-hmm.
Okay. So
Robert has a comment here. Of course,
Yep.
Robert, I believe, I don't want to misrepresent you, Robert. I believe you're a day trader. I could be correct on that. He says, Fred Steele has monthly M1 and M2 data available on a non-adjusted basis. It lags by over a month. In the late 80s and early 90s, the weekly numbers were a hot commodity for Wall Street economists.
Okay.
And now you're not getting them for over a month. And so.
Okay. Well, that's good to know. Okay.
Yeah.
So I'm gonna dig into that. Robert, I might reach out to you, educate myself a little bit on that. So I'm glad we can still get those numbers, and I'm curious to see what that chart looks like. If you would, Robert, throw it up. And when you say non-adjusted, I mean, I assume you mean not adjusted for CPI, for inflation, or seasonal. I'm not sure which you're referring to there, but if you could throw that up there, I appreciate that. All right, so now let's take a look at asset inflation. Chart number 3 there, if you would,
Okay.
Mr. Maestro.
Mr. Maestro. Who was that? Alan Greenspan?
Yeah. In this case, you're the tech maestro.
Let's see.
As we talked about, as we dig into this, money's always going to seek a return, right? So as more money is created, it's going to be invested, period. At least to keep up with inflation, right? Excellent, Robert. Thanks. Not adjusted for seasonal variation. Appreciate that. So as these asset prices increase, it's going to affect how people behave, the psychology of everything. So what we got on this chart here, this is our M2 money supply, is the red line. Green line is the S&P 500 index. You notice basically it tracks with the M2 money supply. Obviously with variations. We can look at the late 90s, the dot-com boom, bust, the housing brings that back up, and then the housing bust 08, 09, and then it comes back up with the money supply. So we're tracking right along with that. And what have the stock market indexes done with the M2 explosion? To the moon, baby.
To the moon.
Yep. So that's about it on that one. So watch this now. As we get into this during inflation, stock markets love inflation. What they hate is high interest rates. So as inflation continues to go up, my feeling, we're going to see the stock market keep going up. There'll be periods of fear and uncertainty and doubt, FUD, right? But I think we'll continue to see them go up as inflation goes, because a lot of these companies have pricing power.
Well, yeah, okay, inflation's going up. Eventually, man, we're all going to be millionaires. If you're watching Coffee with the Rich now, a couple of years from now, if this trend continues, maybe not a couple, maybe more than that, but we're all going to be millionaires. Won't that be a great day?
Absolutely. Problem is, being a millionaire ain't going to be what it used to be.
Yeah, and there was some people holding up signs in Zimbabwe during their collapse, and these young men had said starving billionaires. I'm sorry. Let me say that again. Starving billionaires. And again, because you cannot print your way out of this. Because their $10 trillion notes were like sand on the beach, right? Exactly.
They're everywhere. So do me a favor, bring chart 4 up there, brother.
Chart 4.
That'll be our last one for the day.
Okay. I'll get better at this, Will.
It's all good, brother.
Chart 4.
So what we're going to look at in this one, guys, is these asset prices adjusted for M2, adjusted for money supply. We're going to work through this a little bit. This is a 3-part chart. Kind of stay with me here, guys. So this is since 2009. If we look on the left-hand side of that, it says in their native currency. So in each country's own currency. So since 2009, India's stock market's up 638%, USA 533. You guys can read through the rest of those. Now, that's all great, except we're measuring apples and oranges, because we're, for the Eurozone, we're using euros. And for India, we're using whatever their currency is. I can never remember it. Okay, so now change that all into US dollars. So same stock markets, same since '09, just all adjusted into US nominal US dollars. So now USA is still 533%, but we moved to first place because India, their currency devalued more during that time. So down to 396, and you can work your way down the line. You will notice China stayed basically the same because they pretty much pegged their currency to the dollar. And we can see how that changed each country's numbers. Now let's adjust that for the M2 supply. So when I talk about adjusting that for the M2 supplies, the M2 supply goes up, that depreciates those gains. So it decreases the real power of those gains. Does that make sense, Rich?
Mm-hmm. Yep.
Okay. So now, since 2009, the United States stock market return, instead of 533% in US dollars, when you adjust that for the M2 money supply, you're down to 139% gain. So relative to the increase in the M2 supply, the stock market's up 139% in 11, 12 years. And you'll notice that once you get to Canada on down, those are negative returns. So a loss of purchasing power compared to the M2 money supply.
Well, again, doesn't this lend itself to what they've been doing? Just keep printing money. Let me look at that.
Yep. So this goes back to my feeling that eventually all this money printing, once we fill the globe up with dollars, right, then we're going to see inflation. So I'm extrapolating this out, and I could be completely off base here, but I'm extrapolating this out to mean we're in for a lot of pain because right now we're seeing artificially high numbers in the market. So the USA is showing 533% gain over this period. But if all that inflation that should have shown up did show up, we'd really be looking at 139% gain. That tells me we're looking at some point here a big decrease.
That's just a market correction. That's what those are called.
Yeah, that's going to be a big one.
Yeah.
That one's going to leave a mark in somebody's 401k.
Yeah.
So
which goes back to John's question, how much cash do you recommend having ready access to?
Okay, so a number greater than 0. Okay, I'm kidding. What I do is I keep enough cash on hand to take care of my biggest fixed expense, and it's not truly fixed because it does very little bit, but that's my mortgage payment on my home. So I keep enough cash on hand for sure to handle 3 months of mortgage payments. That gives me time to react, right? I can sit around and play video games for a week while the world crashes, and I kind of wait and see how things shake out, and I still have 2.5 months left-ish, right? And then I look at my other expenses. I got to eat, got to pay the utility bill, go through, and minimum 3 months to have cash on hand. That's what makes me comfortable. Everybody's different on that. Do what makes you comfortable and build up to it. And when I say cash on hand, I don't know about you, Rich, but I'm talking cash on hand. I don't have to go say mother may I to a bank. Because I think we talked about back that 08, 09 time period when I was kind of coming up to speed. I went to the bank and requested, I'll just come out and say it, I requested $10,000 cash. Mm-hmm. And they went, ooh, I don't know if we have that much.
Yeah. That should scare the crap out of you right there.
I had a moment there in the drive-thru, let me tell you.
Yeah.
So that's, to me, that 3 months is the bare minimum to me.
Yeah, now maybe we need to get Robert Davies back on the show, and me, you, and him do a show, because the honest to God's truth is we're self-defense guys. I mean, you're a captain for a major commercial airliner. I'm a retired Marine officer, former cop. Firearms instructor. This is not our forte, but it's forcing us into this lane because we're concerned. We've been paying attention, and I feel like we're being somewhat lied to. Maybe that's the wrong phrase, but
I think you can take out the word somewhat.
Yeah. Yeah. True.
Yeah. Let me see. There was a question there. So Tony asked, where is a good place to put your money instead of the market? I'm just going to tell you what I do. Not financial advice, blah, blah, blah.
Yeah, exactly.
Precious metals, gold, silver. I have some crypto. I have money in the market because let's face it, as long as that wheel keeps turning, it's going to keep going up. And just the knowledge to know that at some point it's going to go way down, I think is going to help me and hopefully help us to be ready when we see the warning signs. Same way people who follow the housing market saw the crash in housing before it came, right? So I'm hoping that the situational awareness this gives us is analogous to keeping your head on a swivel at the gas station.
That's exactly right.
So, so where's the best place? I think a little bit of everything. And you got to keep playing the game until we see the game really get out there. And I don't think we're really there yet. But it's coming, and it's coming fast.
Yeah. Jesse says, I've overheard bank tellers telling people that the bank didn't order enough cash to let them withdraw $5,000 to $10,000. And yeah, my buddy, I was telling him about, hey, when I was up north, they didn't have change. And he's like, well, I was at McDonald's the other day. They didn't have change either to do anything. They're like, well, can you use your credit card? Because I don't have change in the till to give you. And I'm seeing and hearing this more and more. And it's almost like, I don't know. I think these are indicators of something. What that is, we'll only know after the smoke clears. Mm-hmm. And we said the same thing about in March, early March of last year when we were, or maybe late February, we were doing the COVID show before anybody was really talking about it. And I'm like, guys, I'm just running the math here. Mm-hmm. This is a math problem. Yep. And I can tell you where this math is going. I think we're kind of doing the same things. These are canaries in the coal mine along the way. And it's just a math problem.
Yep, exactly. Never had a calculator lie to me, not once.
That's exactly right.
And eventually this will come home to roost. I mean, they'll kick the can down the road. The politicians, man, they're thinking about the next election cycle. And that's why I personally don't think they'll raise interest rates this year, because it's an election year and the Democrats are already going to get slaughtered. And they don't want to get slaughtered worse by raising interest rates and being blamed for a slowing economy. That's just my take on it.
Yeah. Alan says, is the money cash thing a government control situation?
I think so. I mean, what was it? Was it Rothschild, Rich, that said, I care not who makes the laws if I can control the currency?
That's exactly right.
Yeah. So, going back to the, being a millionaire isn't what it used to. When we look back, you don't have to bring it back up, but we think back about chart 4 there about how when you adjust for the M2 supply, look at you. Good. Look at you. Wow. I'm going to get you some extra crayons there, sir. I think this is why, even though the 401k balance has gone up and so we don't feel richer.
That's right.
I think this is why, because we don't see it in the CPI numbers and we don't see it in these other numbers, but it's a feeling, right? I mean, it just doesn't to me feel like wealth is being created at what the numbers say. Does that make sense?
Yes, that's exactly right.
It just doesn't. And maybe it's just because I'm not young and naive anymore and see some of the world for what it is. I don't claim to know everything, of course, but it just doesn't feel stable. The whole system doesn't feel stable. And maybe when I was young and naive, I just believed too much. I don't know.
Yeah, I think maybe we're jaded now that we're in our 50s.
Yeah, could be. It's well earned. So that's everything I got for today, Rich. I do want to hit a couple little current events here.
Please.
Ties into inflation. The USAID released numbers. That's the United States Department of Agriculture. Compared to a year ago, beef is up 34%, pork is up 14%, and eggs are up 79%. Now let's remember back to our talk about CPI and hedonics and geometric weighting in the basket of goods. Mm-hmm. So the Fed is going to have you eating a lot more pork than beef.
Yes.
When they report those numbers. So keep that in mind, guys, how those numbers are massaged.
Can I talk about that?
Absolutely.
So, you bought a freeze dryer, which we'll talk about at some point,
Mhm.
and I've got 2 giant deep freezers that we like to keep full of beef. So I contacted my friend down the road who I get my beef from, and I said, hey, Ricky, I need to get. He's like, buddy, I can't get us any beef for the next 18 months. I'm like, what are you talking about? He's like, because I'm looking in his field, I see cattle out there. What's the problem? And he's like, the slaughterhouses, man. The slaughterhouses are on an 18-month waiting list because everybody's doing this. They're seeing the beef prices go up, so everybody's taking their cows to market to fill their freezers up. So you can't get an appointment with the slaughterhouse here in East Tennessee for the next 18 months.
Wow.
And I say these things, and I know that when you hear this show, I hope what we're doing is combining a little bit of science and a little bit of anecdotal experience to kind of round out the contextual picture we find ourselves in. But so my wife and I were like, no, man, that means we're going to have to, once we run out of beef in the freezers, then we're going to have to go to the supermarket. Oh no, and now I'm going to have to realize those prices, so maybe if you want to start a business, start a slaughterhouse.
Yeah. Yeah. I grew up in the meat business. Killing cows isn't hard. It's once they're dead weight, they're pretty challenging.
Yeah.
So a couple of comments here, and then I'll get to let's do my last little bit here. So
Sure.
eggs are up 79% compared to a year ago. The wife and I were just talking again. We've talked about getting chickens before. I need one more thing to do, but I think we're going to pull the trigger and do it. So that actually ties into the next and last thing on the current events is if you look around, it's not making widespread news yet, but there's a bird flu outbreak in Israel, and it's coming from migratory waterfowl going between Europe and Africa, and it settled into Israel. I want to say 5,000 cranes have been died. Now for supply chain food, cranes are not part of that, but it got into the chicken population.
Uh-oh.
Yeah. So they, as of a few days ago, the 28th of December, as a matter of fact, they've culled 500,000 chickens. I have no idea how many chickens are in Israel, but 500,000 chickens is a lot of chickens.
Sounds like a lot.
Yep. And they destroyed tens of millions of eggs, according to the article that I sent you the link for, brother, if you can put that in the show notes. Okay. And here's where our supply chain thing comes in, with eggs already up 79% from a year ago. Israel has ordered 100 million eggs for delivery. So,
and again, it's like, well, Rich, I don't eat eggs. Do you eat bread?
Mm-hmm.
It's into everything. It's interconnected in ways that may not seem immediately obvious.
Yeah, absolutely. So, all right. So, Tony asks a good question here. What has to happen to our current situation? Here's my smart aleck and real answer to that. Pain.
Yeah. Just
like what rock movie was that with Clubber Lang? What's your prediction for the fight, Clubber? Pain. Yeah. It's going to take pain. Now, is that going to be inflationary? Is that going to be deflationary? I don't know. I mean, maybe Robert has he's obviously way more hooked up on the markets than I am. Maybe he has an opinion. I think having him on would be awesome. Yeah. Get his opinion on what he thinks might come. But it's all about probabilities, guys. That's the way I've learned to look at these things. Is there a probability that our system is going to implode? Yes. And I believe it's close to 100% at some point. When that is, the timing of it, I don't know. Honestly, I hope it's in my lifetime, and selfishly and unselfishly at the same time, I hope it happens sooner than later so that I can handle it and my kids can know prosperity.
That's exactly right.
Yep.
Yeah, which feeds into Alan Kelly's comment. A lot of what you all are talking about is the reason my grandparents and parents were cautious about having lived through the Great Depression. Yeah. And to Tony's point too, there are people, really intelligent people that make a case for deflation. Mm-hmm. And there are smart people that make the case for, inflation up to and including hyperinflation. So which way is it going to go?
Well, it could go both.
It could go both.
It could go inflationary and then deflationary. We could start into a deflationary time period, and they freak out and print a whole bunch of money and overcook it. It could be one than the other. and it depends where you look. I mean, remember back to that chart. Healthcare services have gone through the roof and TVs have gone down. So we can experience both at the same time, depending on which part we're looking at.
That's right.
So, and that's the whole witch's brew of everything. And to Alan Kelly's point about his parents and grandparents, the reason they were that way is because they experienced the pain. And we haven't had real pain in generations now. And that creates a lot of complacency, just like the person who says the bad man doesn't exist because there's guys and ladies out there wearing blue to keep the bad man away.
Yeah. Yeah. Tony says this stuff makes my head hurt. Yeah, I'm with you, brother. I would rather think about, Kimuras and shooting and stuff like that, and than this kind of stuff. But I think the damage this could do to us financially, we have to pay attention to it because this is akin to, like you said, Will, keeping your head on a swivel in a Walmart parking lot.
Yep, absolutely. And, and I'm preaching to the choir here with everybody watching right now. Everybody's going to be listening later. I'm preaching to the choir, but as I've told some people from my generation who want to walk around with their head in the sand, it's our turn to be the grown-ups.
That's right.
And being the grown-up isn't always fun, but that's our job now. And the problem is some people in generations ahead of us didn't want to be the grown-ups. They want to kick the can down the road. So for our own families, we got to be the grown-ups.
Well said, brother. Will, anything else as far as today?
Well, like you and I talked about previously, I think next we're going to move into what we're going to split it up. You're going to handle the household preparations, correct?
Yes, sir. That's correct.
All right. So, food, heat, stuff like that. And I'll talk about, methods of trying to get financially prepared for this and what some likely events are there and how to be ready for that.
Sounds great, brother.
All right.
Anything else?
No, sir. That's it.
All right. Take us out.
Folks, the fight's coming. Be ready.